Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Pavitra Parekh, and Mangalam Malu also joins in for Trading Hour. Hi, Mangalam. 3 days, 3 good days on the trot. Today there is a little bit of profit taking that we're seeing.
A little bit of profit taking, but nothing really to worry about because the mid-cap index is doing well. And in the second half, we have the expiry playing out as well. A lot of put writing. So could there be a second half rally is something we'll be finding out.
So down but not out. Let's quickly tell you how the rest of the market is shaping up. So mid-caps are doing well today, as Mangalam pointed out. Week to date, the Nifty is up 0.5%, but the mid-cap index is up 1.7%. So this outperforming streak for the broader markets continues. Metals are doing well. Pull up the Nifty Metal Index, and that's higher today. There is a Jefferies note. Nigel was telling us about how the Indian steel makers have actually underperformed their global peers, and maybe there is a bit of a catch-up. On the losing side, in the heavyweights, you've got the Adani Enterprises, Adani Ports. So those two names are under pressure. Couple of auto names like M&M, Reliance Industries is in a heavyweight, which is sulking in trade. ITC, TCS too, showing a red tick as we speak.
Oh, absolutely. And, you mentioned the metals pack. So let's pull a few of those names up because this is one space that, that has been in focus as well. So today, this is the one pack which is really holding up. It's doing well. Some of the larger names are up for you right now. Some of the mid-cap names as well. So take a look at SAIL, for instance. You have JSPL, something like a Ratnamani Metals, which is up well. So do keep all of these on your radar. The other pack which has been doing well is the PSU companies, right? We have been highlighting this. So NTPC for the week is up almost 5%. You have something like a Power Grid, which has seen a near 4% move as well. So these are some stocks that, you should track as well. On the downside, we're seeing a lot of the auto names as well today. And you have Reliance, which is seeing some cuts. But let's invite our first corporate on this show right now as well. We have Religare Enterprises, which is surging in trade on the back of an important update that's come through. Its subsidiary Religare Finvest, in a one-time settlement, has repaid 2,178 crore rupees to lenders. It now expects to get a no-due certificate as well. So to discuss more on this, we're joined by Rashmi Saluja of Religare Enterprises to take some questions on this as well as the outlook going forward. Ms. Saluja, thanks a lot for joining us and, taking out the time for this interview. So like I was pointing out, with this one-time settlement out of the way, we do know that you had some fundraising plans via QIP. If I remember the figure correctly, I think you were looking to raise 700 to 800 crore rupees. Can you take us through what the timeline on that will look like now?
Yeah, so we've just completed the OTS we were discussing last time, and this has really been a big achievement for the company, and it also gives a lot of strength to the shareholders and to the management to go back and actually go ahead for the fundraising. So that's going to be in a couple of months. As of now, all my businesses are doing strong and good, and we are completely oiled machinery. The funds are adequately there, and we've just put 300 crores in care health insurance, and so is broking doing extremely well. But yes, for acquiring new businesses and doing some strategic tie-ups, we would be requiring almost 600-700 crores, which I spoke with you. So that's going to be the endeavor in the next couple of months. Now that the legacy issues are behind us, there are no legal issues as such that we cannot go out and do it. So yes, the time for next 3 months is that.
All right, we will, monitor these developments over the next 3 months. Just wanted to understand first, the last time you joined us, you said that once this settlement is reached, you will have a CRAR of 50% plus. Just wanted to confirm that number with you. And secondly, what's the procedure for you coming out of the prompt corrective action? How long before that happens? And what does your book grow at thereafter?
That's right. So that's correct. And now immediately after I get the notice, because yesterday only we just completed paying back the banks. As you are flashing, yes, 2320, yes, we have paid, and we have done it 3 weeks before the 90 days get over. We started paying on the 30th of December last year, and we are done today. And now we will go ahead with the no dues to the RBI, and the proper procedure is that they would be going and getting an inspection done, and they will also see if the companies are ready with their business plans, if they are ready with all their regulatory processes are in frame, and whatever the CAP does, especially whether CRAR is adequate, whether all the other regulatory issues are in place, and then it's going to take at least a month and a half before we are ready for business again.
Got it. Is there a demerger of Care Health on the cards now that the OTS has been completed?
So of course there is going to be a way forward for CARE and for other companies, and whatever is the best for the shareholders and whatever is the best for the the management, and we will be considering that, whether it is an IPO, whether it's a demerger, or whether any other way of doing it, whichever way fits best for the organization as per the regulatory framework. We will be actually looking into all these options.
What according to you fits best? Because I'm just doing some rough math here. Your stake in the company could be worth almost 9,500 odd crores. This is after giving a 40% holding company discount. So are you looking at a demerger? Are you looking at an IPO? You said all options are on the table. Which one do you think will be the best option? Because your holding out there is significant. You're looking to raise 700-800 crores via QIP, but there could be significant value unlocking through this itself, where you wouldn't have to dilute any, shareholding.
That's right. Actually, until just now, until yesterday, we have created the value in the company at REL level. And because of RFL being settled, the value has been created. People do understand it's a nice idea. And now is the time for value unlocking. And for value unlocking, there are multiple ways of doing it, actually creating a robust plan for all the businesses, ensuring that all these companies reach their logical conclusion and they keep growing. But what you asked is that whether we are thinking of a demerger or whether we are thinking of an IPO. First, let me tell you one thing. Whatever we do, we have to first understand how well we fit into the regulatory framework. Nothing is happening unless and until IRDA and the RBI, we fit into that particular. So, we have to do a backward integration. Whichever is best fitted as far as the regulatory framework is concerned, that is exactly what we will be doing it. And I am going to be evaluating both the things. You are right about your calculations on actually, 40% discount and things like that. But that is not as important for me today. Much more important for me today is that whatever I do, going forward, it has to happen as per the IRDA guidelines.
Got it. Have you had a chat with any of the credit rating agencies now that the OTS has been settled? Is there a case for a ratings upgrade?
Absolutely. Absolutely it is. And we have been keeping them warm. We have been giving them the development so that when it starts from now, we've just completed until the cap removal. That is going to be almost a month and a half, where regulatory rating agencies are going to be definitely look at us as a new company where no legacy issues. And of course, the entire net worth has completely changed now. Yes, we are doing that.
All right, got that. Just another question on, the insurance business as well. And actually, I'm going to ask you about the NBFC business first, because we were talking about the regulatory approvals. You have been talking to rating agencies as well. Do you think you'll be able to move forward with that a little bit sooner and get the regulatory approvals that are required here?
Absolutely, we are already at it, and we have been, in fact, in the entire time that we were, especially from 30th of December, that we did our first tranche, almost 85% monies were given to the banks. Subsequent to that, I and the entire company have been talking, and we have been appraising the lenders and the regulatory agencies that where we are, how we are. So immediately after today, we would be starting the next process of getting the, we are going to apply and we are going to request RBI to get the cap removal. And I'm very, very confident that, we are very prepared as far as our, all the other parameters are concerned. And the moment I get a notice in next a few days' time, and then I think so the other process will start.
Do you have any kind of target timeline for this where you think it's achievable?
I think so in a month's time, we shall be in a position to go ahead.
Okay.
You said you wanted to take all your businesses to their logical conclusion. Just wanted to understand what the logical conclusion could it be? I mean, what's the net asset side that you're looking for? Your NBFC business, ideal loan book, the loan book growth rate you are expecting there. How big do you think the insurance business can be for you? And what is the logical conclusion for the broking business?
So there are certain precedents which have been set in market for all these businesses. You know how Star went, and Star really did extremely well. And CARE is actually, if I would say, and it is all thanks to the management and an excellent board that we have. And of course, the partners that we have is Kedara. So we are very much, we are one of the best companies as far as the growth rate is concerned. We are 57%. And that kind of a business model, I would very well say that as a standalone health insurance company is much better. So we have certain benchmarks for a company, which is of course Star. Then we have our own strengths, which are even over and above, which I would consider are much better than the most of the companies. We are regulatory compliant and we are completely solvent as far as the ratios are concerned. So my thought is that this is going to be valued much better than the pair companies, and it has its own strength. Right. So we are going to be evaluating that in next couple of months, which is going to be answering your first question, that how well we will be positioning ourselves as far as the demerger is concerned or the IPO is concerned. And that is where our actually logical conclusion will end for CARE. That is one thing. And as far as our broking is concerned, broking is again doing, this in fact is one of the most vintage company that we have. The entire company started when Ariel went for an IPO. It was much, in fact, on the strength of broking. It is a 25-year-old company. We want to get back to the glory. We are doing certain very logical and certain strategic tie-ups for broking. And that is exactly, I am considering that we are looking at an IPO way for broking also in next 2.5 years' time.
So you've got an IPO for the broking business and a possible demerger or an IPO for the care business.
Absolutely.
Okay. So in the immediate term, in the next 3 months, the idea is to raise money via QIP. 600 to 700 crores is what you've outlined in your interview today. Can you tell us how will you break up these funds and monies into the individual businesses?
I have been saying that moment the OTS is over, we would be, trying, and that is what we have done in last 1 to 2 years. We have engaged consultants how to actually make us as a 360-degree financial services company, for which we would like to, now that NBFC is back on track, we would like to actually create businesses, whether it is the as a web aggregator, whether it's an AIF or whether it's an ARC or an insurance broking, all these companies which actually fit and also strengthen the companies within the group. And those are the businesses that I want to move forward while actually getting our affordable housing company, that is RHDFCL, out of RFL and actually bringing it up at REL level. So these are the areas that we are focusing, and this is where we need money for some strategic tie-ups, acquisitions, and all these things is where we have to actually put in 600 to 700 crores.
Right. Rashmi, final question from my end. I track the FMCG space closely, and I also track where their money goes. I see your shareholding pattern. The Berman family of Dabur, they have around 14% stake in your company. Have you heard from them? I mean, do they plan to increase their stake? You are looking for fundraising. Is there any, further infusion of capital by them possible, and perhaps any change in management?
As of now, I've only heard congratulations, and those congratulations from Mr. Berman's side or from all the other shareholders is what I heard as of just now. And I assume the congratulation comes out of their strength for the management and for the management going ahead. So that is what I have.
Congratulations message coupled with a check as well?
So the congratulations wouldn't come without promises and strengths to the management.
All right.
All right, you whetted our appetite. Thank you very much, Rashmi. We look forward to chatting with you some other time. Get into a break. On the other side, we'll discuss commodities. Manisha Gupta joins in next.
Well, despite a 50-point downtick, the Nifty has actually clawed back above that 20-day moving average, which was a bit of a support in yesterday's trading session as well. After being under it for most of the trading session, we saw an uptick, and that holds today as well after the downtick has been bought into. That can be attributed to the uptick that we're seeing in the Nifty Bank, currently mildly in the green of lows. But that's about equities. Let's shift focus to the commodity space. Manisha joins. Manisha, we're focusing on crude today.
Well, I am, and what a decline we've seen in this week. 5% down already, and today is the third straight day of decline or flat trades, as we can see on screen here. The Brent crude prices started Monday on $86 a barrel, and we are just about holding 82.5 right now. And as I said, it has been a 5% of a decline for the crude oil prices in last two trading sessions itself. And this is even as the US inventories have snapped 10-week of a build-up. We have seen a decline of almost 1.7 million barrels of crude there. But even with that, because there is hawkish US Fed and strength in US dollar, That seems to be weighing onto the markets. And then apart from that, it is various statements from agencies and banks and brokerages which are expecting the crude oil prices to gain, but in the second half. OPEC expects the Chinese 2023 demand that could rise by 500 to 600,000 barrels per day, but they expect that to happen from the second quarter itself. OPEC also says that for this year, the global demand could see rise by nearly 2.3 million barrels per day. Not just OPEC, going forward, Barclays also is quite bullish on crude oil prices. They're anticipating that the market could flip into a deficit of 500,000 barrels per day, but that is in the second half of this year. The expectation also that the Chinese demand could rise by 900,000 barrels per day is there reason to expect that the markets could tighten going forward. You also have Barclays anticipating that for this year, we could average $92 for the Brent prices, but going forward, 97 of an average is what they're anticipating for 2024. Equally bullish report coming in from Refinitiv as well. They're expecting Brent to average at $90 and they expect $100 to be hit as well by the end of this year. They're anticipating stronger demand coming into the markets there. And it's not just Refinitiv. If you look at the other markets, Stancy, JP Morgan, they're also expecting bullish cues in case of crude. Stancy is looking at 91 for this year and even higher prices next year. JP Morgan also talks about an average of 90 this year. Fitch is looking at $95 per barrel of an average this year, but they're anticipating lower prices going forward. Bank of America as well as quite bullish on crude oil prices, 88 of an average in this year, $90 in the next year. And the US EIA for the near term is anticipating some bit of a decline in the crude oil prices. So $83 as an average for the near term. For WTI as well, that the prices could remain at the current levels for the very near future.
All right, Manisha, thanks a lot for getting us all of the details there. By the way, the Nifty Bank has seen a little bit of a recovery led by a lot of the larger names. It is absolutely at the flat line right now, so looking like we might even break into the green. But, you know, take a look at Axis. It's at the high point of the day. You have HDFC Bank, Kotak, ICICI. All of these have moved to the high point of the day. So there is definitely a bit of a bounce coming through in the Nifty Bank. We do have to get into a short break now, but when we come back, we are going to speak with the management of Dream Folks to discuss their business outlook as well as the new acquisition in just a bit. Welcome back. You're still tuned into Trading Hour here on CNBC-TV18, and Dream Folks is the next corporate that we are going to speak to. The company posted a good set of Q3 numbers. The revenue has doubled versus last year. In fact, earlier in March, the board has also approved the acquisition of 60% stake in Witzer Golf. So to discuss more on the quarterly numbers as well as this new acquisition, we're joined by Libertha Peters to take all of these questions. Libertha, thanks a lot for joining us as always and taking out the time. I will come to your Q3 earnings as well because, you know, it has been a good showing. But first, on this acquisition, you've moved from providing access to airport lounges to, you know, the golf courses now. So take us through the thought process there. Are you sort of moving away from just airports, and is this something that you're going to pursue, you know, even more heavily going forward? And also, for now, you've picked up 60% stake. Are you looking at the rest of the 40 as well?
Sure. So the reason of acquiring Witzer is not that we are trying to move from the travel or from the airports. The focus is going to be the travel for us. The reason for adding golf is, if you have actually seen that most of the premium cards not only have the airport benefits, which is not just the lounge, but today even the other benefits like maintenance assist, airport transfers are also being added. And golf is also one of the premium product which has been offered to most of the premium cards, right? And the reason for acquiring this company, or the reason of adding golf, is because we have already built a solution which also, and the solution is such that, to identify the card and the limits on the cards, right? So even golf is being provided on the card level or the bin rate. So the reason of that was that because we already have a solution built in, and we would want to add premium services or premium benefits which are already there in our portfolio. So that was one of the reasons that why we saw that it was a synergy. But the focus is going to be travel for us, because if you have seen from airports, now we also have railway lounges as well. So the focus is going to be completely that. But yes, we saw the synergy in terms of the premium product offering, and golf is one of the premium product. So that is one of the reason. Yes, right now we have acquired around 60% stake in Witzer. So far, there is no such plan that, in future we would be acquiring more. But yes, right now the plan is that we would want to build this product also in our portfolio.
Right.
With this acquisition of Witzer Golf, you get access to 250 golf courses across India and the Asia Pacific region. Would you look to make more such acquisitions in order to cater and provide all the golf privileges across the other golf courses as well, or is this enough?
No, so the existing company itself will be trying to acquire or have contracts with the other golf across the globe. So it is not necessary that we would want to acquire the other company, but the existing company is already focusing on adding more and more golf clubs in the portfolio.
Right, Libertha, it's an interesting sequence of events where in December I remember having spoken to the company when they entered the strategic tie-up with this company, and now you all have gone ahead and acquired 60%. Wonder what led to that, and now wanted to understand by when you acquire the remaining 40%, on which you said you're non-committal right now. Let's talk about your core business itself, which is the lounge business. For the last 2 quarters, you've been doing a quarterly run rate of almost 200 odd crores. I believe this is only likely to rise. I mean, we've seen long queues outside airport lounges, etc. At what rate are you adding these lounges in your portfolio? Secondly, railways, which is a small business, how big can that be for you? And what does all of this eventually mean for your average gross profit per passenger, which is close to around 150 rupees?
So in terms of, I would say, the lounges and the lounge space, what we are talking about, right? So yes, we actually see large queues there. And I think, just to ensure that there is a smooth transition which is happening at the lounges, now we have also have this self-check-in kiosk at most of the airports as well. So to reduce the time of check-in at the lounges. Secondly, in terms of the lounge space, if you're talking about, if you actually see, the average lounge size, which used to be around 2,000 square feet, and today, if you see, the average lounge size is around 30,000 square feet. So the thing is that the airports and the lounge operators both understand the value what is coming to the airport in terms of the revenue as well. So there is an expansion plan, and the existing airports are actually trying and increasing the lounge space in all the metro cities. Not only that, there are privatizations happening in tier 2 and tier 3 cities. So that is going to be the addition to the numbers. Secondly, even the airports where there are no lounges now, understanding the value what they are bringing to the airport, and also understanding the passenger requirement. So most of these airports are also coming up with lounges now. So I would say that, there is no scarcity, or we don't see that, there will be a point where there will not be a growth factor in terms of the lounge space, because we see that, month on month, there are changes happening at the airports, and that too in various airports. Coming to railways, presently, if you see, there are 12 railway lounges in the country. And yes, there are expansion plans happening by the government, who is taking a lot of initiatives to privatize and also have private operators running these lounges. So we see that, these numbers are also going to grow. In terms of numbers, if you ask me, right now, yes, in terms of the airport lounge numbers, these numbers are very minuscule right now, but we see that, in coming years, the railways would be a high potential for our growth as well.
All right, but Libertha, in this context, when you are saying that you expect this kind of growth to come through in the airports space, within the railways as well, which is small now, but what do you think this could mean for your own business going forward? Like we were pointing out, it's around 200 crores annually right now. That's what we've been seeing. Even if you want to give me a slightly, longer term perspective, where do you see this getting?
So too early right now to actually talk about, what the contribution would be. But I would say that, it would actually give a good percentage to our revenue.
I was not talking about the contribution. I'm just saying what your overall revenue could look like. Say
so
for
I would say
FY20.
that, for the railways, you mean?
No, for the overall business, yeah.
So if you have actually seen the growth, the way it has been in our last 3 quarters, right? So I can't give the futuristic numbers anyways. But, the key factors which are driving to our growth is airport traffic and also the credit card penetration. So both are actually the way it is growing. I think both of them are the driving factors for our numbers. So in the same way, we should also be growing.
Okay, Libita, we'll leave it at that. Thank you very much for joining in. That's Dream Folks for you. Slip into a break. On the other side, we'll discuss market technicals. Ashish Kyal, Wave Strategy Advisors, joins in next. Welcome back. Down about 40 points on the Nifty. The mid-caps are holding up well with a gain of about 1/3 of a percentage point. Banks are outperforming yet again with names like HDFC Limited, HDFC Bank at the day's high. Good time then to talk about the strategies that one can take on. Ashish Kyal, Wave Strategy Advisors, is joining in now. Ashish, what would be your individual stock recommendations?
Hi, good morning to you and all the viewers. See, the overall market tone remains bullish and buy on dips, and it's better to be looking forward for buying opportunities here. The first stock pick on the buy side is going to be SBI Card. We can see after a long consolidation over past 2 weeks, it's giving a very good breakout. The volumes are picking up. It's managed to bounce back from that 20 days average, and there is a moving average crossover as well. So looks like there is a good breakout coming in SBI Card. Long positions can be created here. Stop loss can be maintained at 742 for the target of 825. And the next stock on the buy side is going to be Petronet LNG. We have seen a very sharp run up in yesterday's session. Some consolidation is possible today, but that can be an opportunity to buy this stock. It has given a multi-year breakout on the upside. The stock looks good even from the medium-term perspective. So one can create long positions on any dips in Petronet LNG. Over short term, the stop loss can be kept at 226 for the target of 250 and possibly higher.
All right, individual stocks, what do you have for us? All right,
So,
I missed that, Ashish. Thank you for your time and giving us those individual stocks. Slip into a short break, come back, get you more on the markets itself, the way forward with Unmesh Sharma of HDFC Securities. Welcome back. You're watching us here on Trading Hour. The Nifty Bank is doing extremely well, as a result of which the Nifty has recovered from the lows. We're getting some news from Bloomberg saying that ADIA is likely to buy some stake in Lenskart at a valuation of nearly $4 billion. Interesting one from a startup standpoint. We will monitor its ramifications on the listed space. The only direct competitor to Lenskart in the listed space is Titan, so we'll watch out for how that plans out. But again, it's just a very small component of Titan's overall business. We're talking about markets. Unmesh Sharma, who's the head of institutional equities at HDFC Securities, now joins in to discuss the way forward. Unmesh, how do you feel about the markets right now? We've been seeing them move around in a range. What are the sectors that you're backing?
Okay. No, thanks. So, look, no change in view really from our side. We've had a broadly cautious kind of stance since last August. As the market continues to look for some kind of Fed pivot, you keep getting these spots where there is hope that it's going to happen, and then, these keep getting disappointed. And the net effect really has been that the view as far as the terminal rate of interest is concerned, both in the US as well as in India, has only gone up, right? And the inflation concerns continue to persist. Now, you put that into context, emerging market basket in general would see some kind of pressure because of the risk of in this environment. And on top of that, India has never not been cheap through this. So we are seeing the impact of that. I think, our view remains unchanged at this point in time. That we are likely to keep moving in some kind of small band where you'll get spurts of good news and bad news, and really the market continues to prefer within that. Now, how do you play this, right? So if you look at sectors, we've been sticking with the same views. Okay, we stay with the large banks. If you look at what happened in Q3, all the upgrades have been driven by the financials as well as by the IT sector. So we have some selective positions in IT. Banks, and if you look at our model portfolio, I think for the last 2 years, we have been economy facing and value. It continues to remain like this. So if you look at some of our top picks there, industrials, real estate, we have some power names in there, some autos, pharma, and the long-term thematics like gas and financial inclusion, which is basically capital markets and insurance. So yeah, we stick to that. We stick to that view. Yeah.
I was just looking at capital goods infrastructure where you are overweight, and apart from L&T, you also have a holding in names like a KNR Construction, NCC, Cummins. These are some of the mid caps in the space that you like. Now, the target price for most of these companies is just about 10%, upwards of where the stock currently is. I think for Cummins, it's about 1,818, and the current market price is 1,674. For NCC, your target price is 1,100 versus the current market price of 100 rupees. Based on what you are seeing, do you think that, once the market, these stocks go up another 10 odd %, you would exit, or do you think there is a case for you to continue rolling over your positions, your overweight stance?
Okay, so put that into context of where we see the markets headed, right? So I think at the start of this year on this channel, I was saying that we are likely to see single-digit kind of correction in markets, which kind of playing out. Now, in that context, 10%, 12% kind of upside is not that bad. Also, what we believe will happen is that the market will get more and more concentrated because the companies which will deliver earnings, the market will naturally gravitate. I'll give you an example. If you see what happened in the last 6 quarters, the number of stocks in our coverage universe, which is more than 225 now, which beat estimates 6 quarters ago was around 60%, is fallen to slightly below 40%. So what we expect is that money will shift towards companies which deliver earnings and earnings beats. So from that perspective, in a context where we are seeing markets actually deliver some negative kind of returns, 10% is actually quite good in our view. Now, what do we do if there is a rally of 10%? Well, we'll have to see. There's no way for me to know what will drive it there. What we believe is that as companies deliver earnings, and as we walk into the second half of the year, maybe post the June quarter, as the market starts to look at FY25, because right now I think all the stocks are being looked at on an FY24 basis, we will see where the earnings upgrades and downgrades come through. We generally have a very low churn on our model portfolio, but we'll obviously revisit all of this as we start to go into that kind of time frame.
All right, and Unmesh, is there any change in what you think about for IT services as well? And take us through what you think of some of the large cap as well as the mid cap names. I do see that there are perhaps more positives amongst the mid caps from the list that we do have from your report. But take us through what you think of this entire space.
So IT, we are quite selective. While if you look at our model portfolio, is actually slightly underweight. But to a large extent, that is because of our some valuation discomfort that we have on one large name, which is TCS, and that's a slight underweight, even though it's a large position given the context of where it is. So if you look at it from that perspective, bottom up, we like Infosys and HCL amongst the larger ones, and Tech Mahindra Cyient are the two which we have there, and MCX. So what we do is that we also look at the tech-oriented, not just technology services type of companies in there. So IT and exchanges is really how we think about it. So we have an off the portfolio, off the index kind of view, alpha position, so as to speak, on MCX. So that's how we are looking at it. Basically, it's really bottom up. It's tough to find value in the market in general, to be honest, given how much macro uncertainty there is. So if you look across sectors, not just in IT, you will find that we've tried to find pockets where we have very high confidence, good visibility on FY24, and possibility that as we move through this year, and hopefully, we have a little bit more clarity on the macro, we will be able to identify companies where there is clear visibility of growth on earnings.
Right, still quite selective on IT, but you do like the bank space, also overweight pharma that we can see in your portfolio, and a lot of the power plays. But we are going to leave it at that. Unmesh, thanks a lot as always for joining us and taking out the time. We do need to get into a short break now, but as we do that, here's a quick programming note. On the 14th of March, CNBC-TV18 will host what will be India's largest summit on gender parity in Delhi. So women leaders from all walks of life will come together to brainstorm and help take decisive steps to bridge the gender inequality that exists in India and across the world. The event starts at 4:30 p.m. on the 14th of March, and you can catch all the live action right here only on CNBC-TV18. Welcome back, and let's now bring you our special segment Fin Street today, where we are going to put the spotlight on commercial vehicle financiers. This sector saw robust growth in Q3 FY23. So Abhishek is here to break down what's really aided the business momentum this time around. Abhishek?
Well, in Fin Street today, I'll be covering commercial vehicle financiers who have reported robust Q3 FY23 business momentum. Disbursements growth on a sequential basis has been anywhere between 8% to 20%, while AUM growth has also been robust, anywhere between 4.8% to 13% for all the lenders. So what has helped the CV sector? Overall, if you take a look from FY17 to 9-month FY23, CV sales have been pretty strong. Blended realization has also improved massively, especially for medium and heavy commercial vehicles. So for example, Ashok Leyland has seen blended realization increase by more than 44% between FY17 to 9-month FY23. The blended realization is a function of price increase as well as tonnage increase. AUM growth trend of all the players. Generally, the growth trend has been on a YOY basis anywhere between 13% to 17%, and on a sequential basis anywhere between 4.8 to 4.9%. However, outstanding growth was seen for Cholamandalam, who has seen YOY growth of more than 31% and 13% on a sequential basis. The growth for Cholamandalam has come in from the fact that their disbursements to AUM ratio has been at 68% when compared to peers having it at less than 28% and around 30%. So good growth also means that net interest margin should have improved, as we know that NBFC lend to high yielding customers on any product. However, Cholamandalam's net interest margin has remained flat despite AUM growth. In a rising interest rate scenario, Cholamandalam's net interest margin has remained flat, while net interest margin has declined for M&M Finance. Cost of funds has impacted the net interest margin momentum of these two companies. If you take a look, their interest income has increased quarter on quarter, both for Chola as well as MMFSL, while their interest expense has grown massively or higher than that compared to peers on a sequential basis. Borrowing mix remains widely distributed for the likes of Shriram Finance as well as Sundaram Finance, while Cholamandalam does not have access to deposit and has one of the lowest securitization portion as a percentage of the borrowings when compared to peers. Another point to note is that Cholamandalam also has the lowest provision coverage ratio when compared to peers. So Shriram has stage 3 coverage ratio of 50.7%, M&M Finance at 59%, while Cholamandalam has it as around 26.7%. Going ahead, lenders like Shriram Finance, Sundaram Finance and M&M Finance can actually raise funds via deposits at attractive rates from their customers. So Cholamandalam's restriction on borrowings profile when compared to diversified profile of peers can actually hurt its growth in the coming period, or let's say in the next 6 months or so, just in case it fails to borrow at competitive rates from the market. Strengthening of balance sheet may actually hurt return ratios for Cholamandalam if at all they choose to do so. Cholamandalam's performance against peers in a rising interest rate scenario needs to be seen with respect to net interest margin as well as return ratios.
Oh, thank you very much, Abhishek. That was very explanatory. With that, it's a wrap on this edition of Trading Hour from the entire team. Thank you for watching.
Brought to you by HDFC Life. Sir